And there are several stocks in the top 10 and top 20 of both that are top 10, top 20 of the other ones.
Yep.
But they have other companies in there that have done well over time because of their competitive moat. All right. And my last slide is talking about sectors. So sector rotations, and I'm not going to say trading because I don't like to consider myself a trader with clients' money, which I'm not. But when you're looking for some alpha going into the next year, right over here, this column here is the year to date for 2023. I only look at the bottom four sectors. And you can see anytime healthcare was in the bottom four, the type of rebound that had over the next 12 to 24 months.
Yeah.
This isn't a recommendation, but if you take a look at all of the returns with healthcare, right, annually, it's up about 11.5%. This year, it's down 4.1%. So if we just look at average performance going in the next year, there may be a 15% bump, 15% bump in healthcare, if not in the next year, next 2 years. We'll have to see. The other one that I like in here is the consumables, the consumer staples. Now, interesting enough with consumer staples, I don't know why they were down this year.
Yeah.
It's just odd, but typically when consumer staples are down, they will typically have a nice little bump. You can see here in the past how they bumped up. They were down here, okay, bumped up. It's very rarely do you ever see 2 or 3 years in a row where consumer staples are in the bottom four. Why? Because we all need to buy what's in those companies, the Procter & Gamble, Kimberly-Clark's, Colgate, Kellogg's of the world. So I just thought those were two ideas to consider if you got some cash on the sidelines or some T-bills maturing, looking at the next 12 to 24 months. Obviously, you could buy a sector, or the other suggestion, and I want to hear your thoughts, is you look at the top 5 holdings in a couple of these sector funds, and you put money just either into those top 5 holdings or into 2 or 3 that appeal to you the most and have the lowest PE ratio and the highest dividend yield.
Yeah, and I think it's likely to be a good year for dividend paying stocks across the board. When I buy dividends, I tend to buy dividends of companies that either companies or funds. So I'll buy closed-end funds that don't really rely on that constant cash flow coming in, and basically they distribute most of their income in the form of dividends. So I really don't care about the value of it. The value just tends to stay flat, and there's predictable dividend. That's been a great strategy throughout this year for our portfolios. I think it's going to be a good strategy going into next year, because anything that's got dividend payments, as we see these short-term interest rates, and I think my thought process is, if you look at the yield curve right now, and we'll look at it in a minute, the yield curve is really high on the short term and relatively low, although getting closer together on the long term. So the yield curve is slowly uninverting at this point. So it's very likely that we see a move down next year, especially if we see some interest rate cuts. Those short-term rates are going to come down, and then dividend stocks are going to become very attractive again. Specifically, those dividend companies that just continue, if you look throughout their history, they just continue to raise dividends steadily over time. And if they pay out, let's say 50% of their earnings in the form of dividends, and they raise their dividends over time, those are the kind of stocks that you want to look to own in a market where potentially rates are going down, which means probably something else is going on in the economy at that point. And they become more and more attractive because they're raising their dividends over time. It's not a fixed interest rate. It's not a short-term rate that's massively dropped down. You look at some of these companies here, really in healthcare, in consumables, and real estate, and utilities, those 4 lowest categories, all of those are pretty well dividend payers.
And also utilities rarely ever get to the top. They got in here a couple of times, but they're not, they're not meant to do that. But I'll get some hate mail if I don't bring this up, because I've showed this chart to clients looking at some next year, investing thoughts. And people are like, what about energy? Anybody that has ever talked to me or have known me knows that I don't get involved in energy because oil is one of the most manipulated markets in the world. And
Yep.
I thought it was interesting. Energy has done so well the last couple of years. Yeah. But look what it did in the 7 of the 8 prior years. You made nothing, you lost money. So yeah, you finally got it if you stuck in there for 8 years and you made money in the last 3.
Yeah.
But my whole point is too much EKG in there. Look for other things, even for, and whenever I get a client into investment, I have a 3 to 5 year outlook, right? I'm looking for a 20% upswing in the next 3 to 5 years for growth oriented strategies and clients.
Yeah.
So that's why healthcare is a good fit. Energy, forget it. Throw a dart.